Buy now, pay later, also known as BNPL, is marketed as the safe way to spend. No interest, no credit card, no problem. That's the story. It is a convenient way to spread your costs if you can't afford an item or survive up front if you are young. It can help you build your credit history if you don't have a strong credit history yet. It shows that you are responsible enough to handle credit, which in turn can open more lines of credit for you. But here's the uncomfortable truth most people only discover too late. Buy now, pay later can quietly hurt your credit profile even if you never miss a payment. Today, I'm breaking down how lenders actually view BNPL. Why it's become a growing red flag in mortgage and loan applications, and what you should do if you're planning to borrow in the next 6-12 months. BNPL works because it doesn't feel like debt. There's no physical card, the payments are small. The approval is instant. You don't feel the weight of borrowing, which is exactly why people use it more often than they realize. A pair of shoes here, a phone upgrade there, furniture, electronics, and even groceries. Each purchase feels manageable. But lenders don't assess purchases individually, they assess patterns. When you apply for credit, especially a mortgage, lenders look at more than your score. They look at spending behavior, reliance on short-term credit, monthly commitments, and cash flow stability. This is where BNPL becomes a problem. Even if there's no interest, payments are on time and your credit score looks good. Multiple BNPL plans can signal financial stress or poor budgeting discipline. Not because you are bad with money, but because the data suggests dependency on deferred payments. Here's where most people get misled. Some BNPL providers report activity to credit agencies. Others don't, or only report missed payments. So people assume, if it's not on my credit report, it doesn't matter. That's not true. Many lenders now use open banking data, full bank statement reviews, and internal affordability models. They can see recurring BNPL deductions, even if your credit file looks clean. To a lender, that's still a monthly commitment. Mortgages are assessed differently from everyday credit. Lenders don't just ask, "Can you afford this today?" They ask, "Can you still afford this if rates rise? If your expenses increase? If your income changes?" Multiple buy now, pay later plans reduce your disposable income even by small amounts, and that directly affects affordability calculations. This is why people with decent scores get declined or offered lower amounts and don't understand why. Here's the controversial part. Buy now, pay later doesn't make you irresponsible, but overusing it can make you look financially stretched. It trains spending habits around future income instead of current cash, and lenders are becoming far less tolerant of that behavior. If you're planning to apply for a mortgage, car finance, or loan, stop opening new buy now, pay later plans, clear existing ones early if possible, avoid overlapping payment schedules, review your bank statements, not just your credit score. Only borrow what you can pay if it is necessary to use BNPL. Treat buy now, pay later like real debt because lenders already do. Buy now, pay later isn't evil, but it's not invisible either. Used occasionally, it's manageable. Used frequently, it can quietly limit your borrowing power. If you're serious about buying a home or improving your financial position, this is something you can't afford to ignore. Please follow for clear guidance on money, credit, and home ownership without the confusion.